Hey everybody, Patrick Jackson with Mann Mortgage here with this week's market update. Today is Thursday, May 19th. It's about noon on the West Coast. Today, I believe stocks are slightly down, which is a big improvement over yesterday and earlier today. They were both, down quite a bit. And then on my side of things, the things that affect rates, the bond market is slightly up. We were up a lot more this morning, and it's come back a little bit, so we're slightly up there, and we're slightly down on the U.S. Treasury. The 10-year, which I've mentioned before, is the one to watch the closest. So both those things are, positive for rates. Looking at the 30-year lender survey, or I'm sorry, the lender survey for 30-year conventionals, currently, that goes out nationwide. Currently, today it's at 5.36 is the average rate across the nation, where last Thursday it was at 5.35. So really not a lot of movement over the last week as far as that goes. So we did get housing data this week. The first thing we got on Wednesday, which was data relating to new start builds. So I want to share that with you guys real quick. All right, so let's see here. So the number over here on the left, so we'll go start. So the numbers that were reported was that there was 1.7 million starts, which 1.1 million of those were single family homes and 0.6 million were multifamily starts. On average, destroyed annually, we have 0.1 million destroyed annually per month, I guess, nationwide, as far as houses that are just destroyed. So we got to take that out of that. So, based on these numbers, our total supply then, total units is 1.6. And with household formations, according to their data, being at 1.4 million currently, according to them, apparent surplus, it looks like we might have, 200,000 houses surplus per month, which would be a positive thing for the housing markets. If we look at the data a little closer, though, really we want to look at the starts that were completed, because, housing being started doesn't, help. They're going to take quite a while to be finished. That's not really affecting how our stuff is now. Obviously, there's a lot of supply chain issues and stuff like that. So starts completed is actually 1.3. 1 million of those are single family. Multifamily is down to 0.3. Destroyed annually, still 0.1 million. The total unit supply then is 1.2. And with household formations being at 1.4 million, that means our apparent deficit is 200,000, as a deficit per month. So we're adding to the current deficit. If you don't believe, this is a big number, but Freddie Mac, who's one of the big, suppliers of the funds for loans across and deals with housing across the nation, their number, they say our current shortage in housing is 3.8 million homes. So if we're adding to that, that's pretty crazy. It's going to take quite a while to make that up. So, the difference between the data that's being reported, which you might see on national news and stuff like that, compared to what the data actually means, is a little different. Like I said, they're using it more as a, hey, we're fixing this housing shortage, where really, if you look in the numbers, it doesn't look like that's going away anytime soon. Besides that, the other thing we got today was we got the numbers on the April existing homes. So these are houses that closed in April. So one thing to keep in mind is that they close in April. So that means these are people, shopping for homes in February and March when rates were about 1% lower. So what we got over now is month over month sales are down 2.4%, which is down. And then year over year, so last April compared to this April, they're down 5.9%. So again, you might see articles screaming this is a sign of a housing bust about to happen, stuff like that. But really, if you look at the numbers a little closely, so the difference between last April and this April is, one, obviously mortgage rates are a lot lower. Two, prices are a lot higher. And then three, inventory is way down. So with those three things combined, 5.9% year over year is really not that big of a deal. It's not a huge drop. It's not an indication of the market changing. It's really pretty understandable given everything. And on top of that, right now, I think the median home price is up 15% across the country. Currently on market average is about 17 days. There's about a 2.2 month supply of homes nationwide, where you'll hear, I think that the ballpark number is about 6 months is a healthy market where neither benefits the seller or the buyer. But 2.2 million or 2.2 month supply nationwide. And really, if you're watching this video in California and Oregon or other populated areas, it's probably much lower than that. I think the number I've heard here in the Central Oregon area, Bend area, is about 2 weeks right now, is I think the last I heard. And then going back to, housing bubble, one thing to keep in mind is before the housing bubble 15 years ago, 2007, 2008, there was about 4 million homes available nationwide. Right now, there's about 1 million homes nationwide. So it's a completely different situation. One other set of numbers we did get that are a little concerning is unemployment numbers have jumped up. I think it was 22,000 more files this month compared to last. That's something we want to keep an eye on because unemployment rate, if we see that starting to spike, then that's an early indication a lot of times of oncoming recession. So if we see that to start to spike, then we'll have to keep an eye on that as far as possibly a recession coming up. The last thing I want to talk about is adjustable rate mortgages, which ARMs. Over the last couple of years, they haven't been a thing. They haven't made sense. But with the shifting markets, adjustable and with the what we think is going to happen over the next 3, 5, 7 years in our economy, they're starting to come back as more viable options, especially for jumbo loans. With jumbo loans right now, we're seeing on a 7-year, 6-month term or a 10-year, 6-month adjustable rate mortgage, we're seeing the average rate about 0.75 of a point lower than on a 30-year fixed jumbo loan, which at that price point could be quite a bit of monthly savings. So those are something that didn't make sense for a long time, but with the changing markets, now we're starting to see those more as a viable option where people can get the ARM, get that lower rate early on, and then just know that they want to refi or they're going to sell or whatever it may be before that period runs out, and then that rate possibly adjusts higher. So that's something to keep in mind for any of your clients that are looking in that rate, looking in that the jumbo loan higher price points. ARMs are starting to come back as a good thing. Besides that, just thank you for watching. If you guys have any questions, just please let me know. Have a great day, guys. Bye-bye.